Hello, callers, and welcome to another accounting lecture presented by 1-800-ACCOUNTING. I'm your host and founder of 1-800-ACCOUNTING, Derek Richard. For those who have not already, please head over and join our call sheets. You can book a live learning and also review our membership packages on our website. Today we're going to be discussing depreciation, depletion, and amortization, which are essentially the same specific terms used to describe the rational allocation of costs. The difference on when to use them is going to depend on the resource that's being allocated. But before we get into that, as always, let's review the accounts we're going to discuss today. Now, remember, for these, you should be creating flashcards with the account on one side and each of the attributes listed on the other. You can also peruse our learning addendums for a printable version. Now, today when we discuss about depreciation expense, that's going to be relating to the fixed assets. The amortization is going to generally be used for intangible assets, and you may hear the term with revenue recognition, debt and investment instruments, or similar areas. Depletion is only going to be used when we're discussing natural resources. Now, as these are related, all of these are going to be listed as your contra income accounts, which means that they're going to represent a normal debit balance. Temporary, as they're going to close into the retained earnings at the end of each period, and they're only going to be presented on the income statement or related disclosures. Now, the key concept today is the rational allocation of historic costs. So what does that mean? First, the rational means that it's going to be reasonable, mathematical, systematic. We're going to be able to point to how we decided to do this. It's going to be based off of historic costs. Now, for this, we're just going to simplify it and go with purchase price, but you're going to need to go to each of those specific lecture slides to learn what all goes into that beginning balance. And we're going to focus on the allocation, that is the division of the cost between the multiple periods. Now, all right, so first let's look at what are the accepted rationalities. Now, the three we're going to learn about today are all considered GAAP. That is, they are accepted when you're producing financial statements that are going to generally be issued in the United States. They're also accepted under the IFRS model. Now, for tax, the IRS is going to stick with a modified accelerated, specifically MACRS. We'll go into that one in detail whenever we're going through the tax exam. For now, we're going to learn about straight line, which is just recording the equal amount of expense each period the asset is in use. We're going to learn about accelerated, which is recording an equal percentage of the net book value, not to exceed the useful life each period, such that each subsequent period recognizes less and less. We're going to look at the usage method, which is recognizing an equal amount of expense to a defined activity based on the usage of each period. Now, before we go into exactly how do we use those rationalities, let's go define a few terms for us. So first, the net book value. This is going to be the historic costs less the accumulated depreciation. I say depreciation here, it's depreciation, depletion, amortization, whichever one we're discussing. The useful life is going to be the amount of periods the asset is expected to be in service. For now, we're just going to focus on annual, but note that if you are producing monthly financials or quarterly, then you will need to further the annual depreciation into months. The salvage value is going to be the expected trade valuable or the recoverable cost of an asset at the end of its expected useful life. We're going to discuss what happens during a change in estimate, which is basically we're going to update our assumptions based on the information that wasn't previously available. So we've gone through 2, maybe 3 years of it. We now know exactly how our people are using it, how the wear and tear is working. Maybe there's a new product that has come onto market. Any change in estimate, we're going to require a prospective change. Now, I capitalize pro to keep in mind that this means we are not going to change any previously reported balances. So that's different from a change in principal or an error. This is just considered a new estimate. Hey, we did what we the best we could in previous periods. We know more now, so we're going to update that today. And then we're going to go forward using our new assumptions. We are going to have to disclose that a change was made and what that impact was, but it's only going to impact this year and any future periods where that estimate is in place. Let's get into the math on it. So first up, straight line. We're going to use this scenario and you can see the different depreciation expense that it's going to generate for each use. For scenario, we're going to use that Richard Co. purchased equipment for $100,000. The entity believes it will be able to use this equipment without major repairs for the next 5 years. Given the location, it believes it will be potentially still able to sell the property in 5 years for $20,000. So first thing to do whenever you're looking at these problems is to identify what information is relevant and what information is irrelevant. Today I've focused on just the relevant information of the scenarios, but note in the CPA exams and a lot of things with accounting, you're not going to get much complex than this, so they're going to have to confuse you. They're going to add more and more details that just aren't relevant. So bury down into what can we use, and then we'll go into the calculations. So if you're using straight line depreciation, the only relevant facts are the historic costs, the useful life, and the salvage value. And again, in this case, the historic cost is $100,000. The useful life is 5 years, and our salvage value is going to be $20,000. Therefore, the required calculations is the depreciable base, which is going to be our historic costs minus our salvage value. So we take that $100,000, we subtract the 20, and now we have $80,000. So what this means is that we spent a total of $80,000 on this equipment, and now we have to rationally allocate that cost over the life that we're going to use this product. So we're going to use this equipment for 5 years. We have $80,000 that we need to allocate. So we're going to do a simple depreciation, 80,000 divided by 5. That's going to give us 16,000 a year. And therefore, each year, year 1, 2, 3, 4, and 5, we're going to depreciate equally the $16,000. And then at the end of it, you'll notice 5 times 16,000 is 80, which means we have the $20,000 salvage value. And hopefully everything works out. We get to sell it for the 20, everything clears off. If not, we'll discuss that during the fixed asset section. Now, the next method we're going to learn is the accelerated depreciation. This takes the example and assumes that new equipment is going to generate more usage earlier on than later periods. I'm learning in life that that's actually pretty true. The older you get, the harder it is to just come up with the same productivity. With equipment, you have wear and tear, things of that nature, and so you end up producing more widgets out of a new equipment than older equipment. And because we are trying to match expense to revenue as best we can, assuming if you produce more widgets, you're going to generate more revenue, we want to match more of this cost to the earlier periods than the later. Now, this is the approach the IRS takes, except they have a very detailed, modified, accelerated depreciation method. We're not going to get into the specifics of it. Just know it's basically a double declining. And what that does is it takes the rate of decline and actually multiplies it by 2 and uses that as the depreciation rate. We're going to learn just simple accelerated. And again, you can use whichever rate of decline you believe is necessary, whatever that acceleration, however many more widgets you think are going to be earlier than later. As long as it's reasonable, you apply it to all similar asset classes. It's not going to get that much scrutiny. What's really going to matter is if you're constantly changing these principles, if you're going from one method to another, that's going to require more and more disclosures. that's going to become more of an issue and look probably more audit scrutiny. It's best to just keep one method and go with it. However, if you do end up getting information in terms of the usage and feedback, don't feel that you shouldn't change because of those things. It's just that you don't want to do it too often. Okay, so under this method, we're still taking the same facts. The difference here is that instead of depreciable base, we're going to focus just on that net book value. Now keep in mind though, the net book value is the historic cost minus the accumulated depreciation. That's going to be the inception to date depreciation. Remember, accumulated depreciation, although it has depreciation, depletion, amortization in the title, this is a contra asset account. That means it's a credit balance, and it's the inception to date, it's the permanent balance, and it's going to show up on the balance sheet. Okay, so that is going to update each year, which means the net book value is going to decrease each year. So even though you're using the same rate of decline, your depreciation expense is actually going less and less. As you can see, in year one, we have no accumulated depreciation. And so we're going to take the full 100,000. Again, that's different from the straight line where you'll take that salvage value out. Ignore the salvage value for now. Depreciate based off the full 100,000. Now, because we ignored the salvage value, once you get down to year 4, year 5, assuming nothing has changed, you might accidentally try to depreciate more than depreciable base. You can't go further than the 80,000. Okay, accumulated depreciation should never be more than what the depreciable base is. It's just that we're going to ignore that for our calculation because we don't want that constant 20,000 at 20% holding up. We're going to wait till the very end, and then if the number we calculate is higher than the remaining depreciable base, at that point you're just going to take whatever's left and then it'll be fully depreciated. Ideally in these situations, once it's fully depreciated, we sell it, dispose of it, whatever we need to do. It should no longer be on our books after it's been fully depreciated. If you get to the point that something is fully depreciated, that means that your estimate was wrong if it's still in use. So at some point you should have gone through and updated those numbers. If that's not the case, then you're going to be needing to see how often you get assets into that position, and maybe you need to look at your overall guidelines and principles. If you're getting to fully depreciated equipment and your equipment's all at 3 years, well, then maybe you should be applying a 5-year standard, 6-year. Same thing if you're getting rid of assets that aren't fully depreciated constantly, then maybe you need to shorten those useful lives. But typically it's best to set up categories, so all equipment is going to be one way, all buildings another. You want to have simple guidelines so that way your employees can follow for new equipment. Now, the last method we're going to learn today is about usage. Okay, so the first two methods we learned were looking at time periods and figuring out the best way to divide the cost over the time period. This method goes a little bit more detailed and actually counts what the usage is. So this isn't going to be used for buildings because it's really hard to determine the usage of a building, but it's generally going to be used more for your plant and equipment types. Now, this method we're going to go, or this example we're going to use that there's 100,000 widgets that the entire lifespan of this equipment can produce, and we're still going to have the same 20,000 as salvage value. And in years 1, we have 25,000, and in year 2, we have 20,000. So that right there highlights again why this method is deemed to be a more accurate method if you can calculate it, is because in the straight line, we just took simple divide it, everything's equal. We do know general wear and tear is going to cause some earlier productivity gains versus later in its useful life. Double declining acceleration might go to the extreme and put too much of that cost early on. Usage tries to define exactly over its life how much can it produce and how much did it produce each year. So with that in mind, again, the same facts, except we're not focused on a time period here. We're focused on the lifetime activity. This is how many widgets it can produce. We're going to go back to using depreciable base since we know we only want to depreciate 80,000. We're going to make sure we only depreciate that 80,000 over the 100,000 units, which calculates to 80 cents a unit. In year 1, we had 25,000 widgets, and so we multiplied that by 80 cents, and we got 20,000. So we will record depreciation expense of 20,000. We're going to record 20,000 times 80 cents to get you 16,000 in year 2. Okay, and you can see we're going to continue with that. Talking about and how to calculate it, just want to make sure we go through the actual journal for it. So here, note that this is a 12/31 journal. That means that we're doing this at the end of the period. This is under adjusting entries. There's not going to be anything that tells us during the month, hey, you got to record depreciation expense, because it doesn't help us to do this calculation every single day. Instead, we're going to wait until after month end. We're going to create our depreciation schedule, and we're going to create this journal and post it every month at the end of the month to recognize the additional expense that we generated for that month. Again, I'm assuming that we're looking at monthly reporting. If your only focus is quarterly or annual, feel free. It just depends on how often you're actually presenting balance sheet and income statements for people to review and how often you want to go through that exercise. But for GAAP, every financial statement, you need to record the depreciation expense up to and since the last financial statement. We're going to be increasing depreciation expense during our journals, and therefore depreciation expense being that contra income account, we're going to want to increase it by giving it the debit. And the accumulated depreciation, remember that's the inception to date, that is going to want to be a contra asset, so it's looking at the credit account, and therefore we're going to increase it at the same time. For those that remember, accumulated depreciation being the contra asset on the balance sheet, that's going to show up on the left side of the accounting equation. Depreciation expense is going to be a negative on the right side under the equity section, rolling up into income, which rolls into retained earnings, which is a part of that owner's equity. So therefore, you're decreasing the left side at the same time as you're decreasing the right side. Everything else is balanced. Except you will always have some change at some point in your life, and therefore we're going to discuss what happens when you do get that change in your depreciation. Now, we're going to take the usage here. Note that if you're using straight line, you still might have changes in estimates. Maybe the salvage value goes down or up depending on whether the useful life stays the same. You might end up having a the acceleration. Maybe you're using double declining and instead you want to use a more conservative approach. Whatever the change is, whatever the assumptions that you're adjusting, the key to note is that we're only going to be focused on prospective changes. That means that we cannot change the past. Whatever we recorded is fine, because remember, it wasn't an error. We hopefully did the best we could at estimating what we thought was going to be a rational allocation of that cost. We're now under the impression that that was a bad estimate because we have a year, 2, 3 years of new information. Ideally, all new information should be checked against our current assumptions, and if a change is necessary, we should be doing that. Okay. In this example, instead of 100,000, we decided we're just not going to sell it. So we'll actually be able to get 120,000 widgets out of it. Now, we might be able to stretch that into year 6. Maybe we're doing double time and we're going to do year 4. Either way, at this point, our salvage value is going to go to 0. So again, we can change salvage value, we can change the base, whatever the change is, we're not going to change past information. So the accumulated depreciation is going to be the same in year 1 and year 2 based off of our last calculation. So the last calculation gave us a total accumulated depreciation of 45,000, and we produced already 45,000 units. Okay. Now be careful when you read the scenarios. I was nice and gave you totals, and so you had to take out what we've already done. You could also be given this information as from this point on. So some textbooks will say that there is no salvage value recoverable and 75,000 more units can still be produced. That will ignore how many we've produced so far and tell you how many from this moment on. So again, be careful of how the information is presented to you. This information, we gave you the total, so you have to take out what's already been utilized. So our depreciable base is going to need to be recalculated. Again, we're not going to change history. So our new base is going to be the net book value at that change. Again, we don't have a salvage value here anymore. If we did, we would take the net book value at change and then subtract out the salvage value of the new estimate. Again, our remaining activity is going to be the lifetime activity they told us minus the units produced. And then that gives us a new cost per unit of 73 cents. And in year 3, we multiply that 73 cents by the 15,000, and that gives us 11,000 units. Okay. Now, the final thoughts that I want to give you today is coming from Mark Twain. Buy land, they're not making it anymore. Although this is just a fun quote for you, the key to remember is that you never, ever, ever depreciate land. Now, the reason for that is because the salvage value is going to always be assumed at least equal to the historic price, and generally more than that. Now, what that means is that the land itself, now we're not talking about the parking garage, we're not talking about even the asphalt that you put on it. If it's land value, that land, they're not making it anymore, and so the value of it cannot go down. Now, I understand different markets, different things. For the most part, the land itself is not going to decline in value, and therefore we are not going to depreciate that because there is no rational allocation, because the rational thought is that the cost of that is 0. It's just going to hold it until you end up selling it, or at any given time you're still holding value in what you have. And so therefore, no depreciation should ever be recorded. And that's all I have for you today. I hope you enjoyed our lesson. And remember, please go to our website. You can join our call sheet. We will be offering access to one monthly featured video. We'll provide you 10% discounts on all our live bookings. All alerts on new courses, lectures, and other content, you need to hit that sign-up sheet to get the emails. You can book live learnings at any time, either by asking a professional, by sending a quick text, email, any question. We'll get back to you within 24 hours. You can book one-on-one sessions with our professionals, or you can join a coordinated group learning where we'll teach either your classmates or even your coworkers. If there's specific areas of accounting that y'all would like us to look at, just get with our professionals and we'll figure out the best timing for that. Look at our membership packages, which includes individual lectures and courses, monthly and annual subscriptions, or just go ahead and purchase it all one big time and you can get anything we produce for life. Thank you all, and we'll see you next time.